So now that we've talked a little bit about the demand for money and why people demand money, specifically that cash, those checkable deposits, whether it's a transactional demand, whether it's that precautionary demand, or whether it's that speculative demand, now that we've covered that, let's dive into the aggregate demand for money formula. So the demand for money reflects the liquidity preferences of household and businesses. That liquidity preferences, are we going to take that money and place it into checkable deposits in cash, something that is highly liquid, meaning we can go out and spend it today to be able to buy goods and services, or are we going to take the more or the less liquid aspect and place it in non-liquid assets, maybe something like land or equipment or buildings? So that demand for money is going to reflect that liquidity preference for both households and businesses. If we believe that the asset values are going to be going up, we're going to probably be taking and placing our money in more non-liquid aspects because we think we're going to earn money off of those non-liquid assets. Versus if we're looking at the future and we're saying, those liquid assets or those non-liquid assets, maybe the price of land or the prices of houses or the prices of equipment are going to be going down in the future, we might be taking our money and putting it more in those liquid preferences, something like holding cash and holding checkable deposits. So people are going to invest in those non-liquid assets or invest in assets in order to earn an interest. So people invest in assets in order to earn an interest. So why would people place money into an account, a 401k, or place money into a stocks or bonds? Well, the reason why they're placing money in those stocks and bonds is because they are really hoping to earn an interest, earn some kind of money off of that. People aren't going to place money in stocks and in bonds just for it to sit there and not earn anything. They're going to try and invest that money, place it somewhere to where they can actually earn an interest or earn money off of their accounts. So why are people going to, in agriculture, for example, why would somebody invest in a tractor or invest in livestock or invest in something? Well, they're going to invest in, let's say, that tractor because they believe that that tractor is actually going to earn them an income or earn them more money, earn them money on the money that they're spending so that it's earning them some type of interest. Why are people going to invest in livestock? In the last video, we talked about maybe they're going to go out and buy some type of livestock. Well, why are they buying that? Because they believe it's going to actually earn them money, earn them interest on that loan. So people are going to invest in order to earn money, to earn an interest. So the lower the interest rate that they're receiving, so whenever people are investing money into a particular type of asset, they're hoping that they're earning an interest rate, and that interest is money coming into them. They're not paying this interest out because they're investing in it. This isn't like a loan. This is money that they're investing, so the interest is coming back to them. So the lower the interest rate, the lower the opportunity cost of holding cash. The larger the quantity of money demanded will be. So let's think about it this way. Let's say you've got a savings account because you earn interest on your savings account. And right now, savings account interest is low. It's real low. So we have two different options. We could hold that money or we could invest it in a savings account. If we hold that money, we forego the interest of that savings account. But if the interest in that savings account is, say, 0.2 or 0.02%, then that's a relatively low interest rate. That is actually a very low interest rate. And it's not going to cost us, the only amount that we're giving up is 0.2 or 0.02%. We're giving up a very small amount. So if you remember, that opportunity cost is that foregone income. The only income we're giving up is that 0.02%. That is a low amount. So if we're going to be losing a very small amount, why not just keep it as cash? So the lower the interest rate, the lower the opportunity cost of holding that cash. And people are just going to keep more money as cash. The higher the quantity of money demanded will be. Now, sorry about that. On the other end, the higher the interest rate, the higher the opportunity cost of holding cash. So more investments will occur and less quantity of cash will be demanded. So let's think about it this way. What if instead of facing a 0.02% interest rate, we're facing a 10% interest rate, which means essentially if we invested $1, we could earn 10% on that dollar, or 10 cents on that dollar. So let's think about it this way. What if you now had basically $100 that you could invest, and before you could invest that money at a low interest rate of, say, 2%. So if you invested that $100 and it was 1 year non-compounded, you get $2 at the end of the year. So you invest $100 and you got that $100 tied up for a course of a full year, you get $2 back. That's a low interest rate. Now, on the other hand, what if you could invest that $100 at 10% compounded annually? At the end of that year, you get $10 back. Well, $10 is a heck of a lot higher than $2, right? Now, what if we're talking about large sums of money? So if we invest, say, $1 million, or let's say $100,000. Let's say you invest $100,000 at 10% interest. Now, at the end of the year, you got $10,000. Now you've gained a lot of money by simply just placing it at that high interest rate. So the opportunity of holding that cash, or the opportunity of holding cost of holding that cash at that 10% interest rate for $100,000 is $10,000. So the higher the interest rate, the higher the opportunity cost of holding that cash. So if the higher the interest rate, we're actually going to be placing more money in those investments and holding less cash, or demanding less quantity. So the higher the interest rate, the higher the opportunity cost, and we're actually going to be holding less cash and placing more of that money in those investments. Another aspect that comes into play in terms of the aggregate demand for money is the larger the amount of disposable income, the greater the amount of cash balances held in an economy. So the more disposable income that we have in an economy, the more cash we're going to keep. That makes sense. The more income we have, the more we get to keep, right? Or the more disposable income we have, the more cash we're going to be able to have. So the larger the amount of disposable income, the greater the cash balances, and the lower the interest rate, the greater the cash balances, because at a lower interest rate, there's a low opportunity cost of holding that cash. So because of that, we can now develop our aggregate demand for money formula. So our aggregate demand for money, that money demanded, is going to be equal to the C, which that C is this autonomous quantity of money demanded. Just like in the past, whenever we had autonomous investment, we had autonomous consumption. Now we're going to have an autonomous quantity of money being demanded. That means that there is going to be a certain amount of cash that's held on your person, even if the interest rate was zero, and even if we had a zero interest rate and we had a zero disposable income, there's still going to be a specific amount of cash that we are going to hold on hand. The next aspect is we have this D. This D comes into play, and that D is the interest sensitivity of the demand for money. So we're talking about this interest that we're talking about up here. There is going to be a certain level of sensitivity. We know the higher the interest rate, the less money we're going to keep on hand, but there's a sensitivity there. How much are we going to do? So this sensitivity can also be calculated by taking the change in the money demanded divided by the change in that interest rate. We know that a change in this interest rate is going to affect this demand. So we're going to be calculating that interest sensitivity. This interest sensitivity is also the slope of this demand curve. So then this I is equal to our interest rate. So we've got the market rate of interest coming into play as well. Then we get into this next component. We've got this E. The E is the income sensitivity of the demand of money. So even though we have a disposable income, and we know the higher the disposable income, the more amount that we're going to have on cash, but we're also going to be placing some in savings and some investments. And there is that income sensitivity to come into play as well. We know that the higher the disposable income, the more we're going to keep in cash. But how much of each dollar that we have in disposable income is going to go into cash? So then we get into this equation down here. The change in the money demand divided by the change in our disposable income, that is going to be equal to our income sensitivity for the demand of money. So then the last aspect that we get into is this level of national income. The level of national income is going to be a component that's going to help us determine our disposable income. So that level of national income, if you remember back to previous videos, that's going to be equal to the GDP, equals the GDP in the national income and product market. So we have that equilibrium level of income within an economy, and that's equal to that GDP, that national income, and that product account, like we've talked about before in previous videos. That is that national income. So essentially, we know that the amount of cash that we're going to keep on hand is going to be a function of our interest. The higher the interest that we can earn, the less money we're going to keep in cash, because we're going to be investing it in investments, in those assets. And we also know that the more disposable income we have, the greater our cash balances are going to be. So because we know those two things, we can actually create this demand for money. This demand for money is going to be this autonomous demand for money minus this investment sensitivity times the market rate of interest plus this income sensitivity for the demand of money that's tied to our income times our national income. So that's our formula. That's our aggregate demand for formula, or for money formula.